Hello guys, how have you all been doing? So today I'm gonna break down this trade that I caught last week. It took a week for it to hit TP, but at least it is 1 TP. It's a 1 to 20 risk to reward, as you can see right here. So if any of you have watched the last video, you know that we long the market from we use the internal market structure to find this long from here to this supply right here, which actually got traded, which actually it did respect our lower time frame confirmation. So we didn't find a sell from that area, but we waited till it reached this supply for me to actually sell the market from here, as you can see. So today I'm going to break down this 1 to 20 risk to reward. If you want to break down for this previous trade, I can break it down for you. You can go watch the previous video if you want the breakdown for this 1 to 24 risk to reward. So today our focus on this 1 to 20 risk to reward, which actually respect as you all know, the market structure is bearish for this pair. It's bearish, as I said in the last video. It's bearish for this pair from here, low, lower low, and actually another lower low right here, as you can see. And it actually was breaking structures to the downside. Lower low, this higher low, and this lower low. Sorry for the English. This lower low right here again, and this lower low right here again, as you can see. The actual market structure is better. For the internal market structure, you know, we have internal external market structure. What is internal market structure and not external market structure? External market structure is the bigger picture it's the bigger picture of a price action. For example, right here we have a bigger picture of a bearish market structure, and within that bearish market structure we have a bullish move sometimes. Like for example, right here we have a low high, low high. You see that as an internal market structure that actually leading to a supply. So that's the internal market structure. For the external market structure is the bigger picture. Internal market structure is the smaller picture of a bigger picture. You get me? So I hope if you want a video that may explain the market structure, I can do that for you. But let's delete this and actually show you what I saw for me to sell this market and what was my confirmation. 5-minute time frame. This 5-minute time frame, I want to explain to you from the previous trade that we caught, the 24-hour, to today's trade that we caught all the risk to reward. So this is the lower time frame. Let us go to the 1 hour. Let us go to the 1 hour and see the actual market structure. As you can see from the higher time frame, the market structure is bearish. So we're actually looking for sales when the market structure in the higher time frame is bearish. When the market, for example, from different time frames, we have like the 5-minute can be bullish, the 15-minute can be bearish, the 1 hour can be bullish. So it differs from different time frames. So for example, when we go to the lower time frame right here, let's just go back to the 5 minutes since we got the bigger picture of this trade, which is actually a bearish trade. So we are looking for sales on the bigger picture when it reaches a point of interest that we are looking to sell the market. But from right here, we are looking to buy the market from the internal market structure, which is the 5-minute. The 5-minute is bullish, as you can see right here. I actually predicted that this supply is not going to hold. Why it's not going to hold? Let me show you so the market, when it reached this supply that I wanted to sell the market from, if you watch the last video, this supply right here, when the market reached this supply from the previous video, I was actually looking for sales. I was actually 100% looking for sales. But when it reached that supply, I was looking for a shift in structure. So let's read the market structure here. The market, when it reached that supply, it made a high reaching the supply, made a low, made a high, made a low. I actually wanted the market to shift structure from this low, since I didn't want it to actually invalidate the high of the supply right here. I didn't want it to invalidate it. I didn't want it to invalidate the supply, but it actually went and invalidated it with a very bullish move right here. After it made the bullish move, it made another low, invalidating the supply. After invalidating the supply, I said this market is no longer going to sell. This supply is not going to hold. So as you can see from the structure, made a high, made a low, shifting the structure. I was actually looking to sell from here. As you can see, I put it my supplies right here. As you can see, supply right here, market selling, supply right here again, supply right here. The market kept on selling. But the bigger picture for this is actually a 5-minute time frame, but the bigger picture from the 1 hour, we've reached a level of demand that we got the buy from. So I was looking a buy from here. I was looking for buy since it's actually met all the criteria that I need. I have a liquidity right here. As you can see, we have liquidity. We got traded here. This demand actually got traded, and this demand actually got traded too. This one get traded also. We are making break of structure to the downside. But what made me look for a buy? I didn't buy this market. Let me be honest with you. I didn't buy this market because this wasn't the time to buy. We don't buy from a point of interest directly. We have to find a confirmation. If you have like a, for example, when you go to the lower time frame, you have a market structure shift from right here on the 1 minute. Since this is the 5 minute, if you have a lower time frame confirmation from this point right here, like a 1 minute, we have a market structure shift liquidity graph from this point, I can buy. But I was not actually looking for it. I've already marked the supplies above. Like I said in the previous video, I have the supplies above. If it reaches those supplies, I can sell from it. As you can see, it actually reached that supply. When it reached that supply, it was the last supply I have, so we have to sell from there. You don't actually have to sell. The market can keep up buying, but from the actual market structure, from the way back, from the daily time frame, this bearish, I can't sell from a bearish market structure when it reaches a supply, because we don't have any other supply right there. It actually invalidated this supply. We are going to have a bullish market, but if we invalidate this market, this supply, we're going to have a bullish market. So what did I do? I actually took my tool and made a, when it reached this supply, high, low, high, invalidating the supply, low, and actually shifting the structure to a bearish move. After shifting the structure to a bearish move, it actually invalidated all the demands we have. For example, if you are a market structure trader, from right here, you're going to say we are going to buy from this demand. We are going to buy from this demand right here. And the demand actually got invalidated. As you can see, the demand got invalidated. After I got invalidated, I was so sure that you are going to sell from here. So what I did, I took my Fibonacci tool, and since we got a shifting structure from here, we got a shifting structure from here. After we got a shift of structure from here, which is a liquidity graph, most of you will say, but we got another major shift in structure right here. So after we got all these shift in structures indicating that we are bearish, so what did I do? I took my Fibonacci tool. As you can see, I took my Fibonacci tool from the high to the low right here, from the high to the low. Then I wanted a demand or a fair value gap to correlate with my supply. So if we look at the 71.6 level right here, that actually within the territory of that shift in structure, as you can see, and we have the 61.8 level. Market usually tend to respect the 61.8 level more than the 71.6 level, but this time I actually took the 71.6 level as my point of interest, where I'm looking to sell the market from right here. As you can see, we use it right here. We got mitigated around here. As you can see, we got mitigated around here, and our stop loss is going to be at the structural high right here, at the structural high right here, the last high that the market made. Because if it was actually to break this high, the trade will be invalidated. We are still bullish on this market, but fortunately we was bearish because we cannot predict every move in the market. So you cannot predict each move in this market. You cannot predict everything, but you have to analyze what you can see and play the game of numbers. If you lose, that's good. We have a very high risk to reward that we can cover up all our losses. So if you want a lesson on risk management, I'll also do that. But if you want, not every risk management, but the risk management that I use, because I'm a high RR trader. So the high RR trader for some people will be different depending on their strategy and depending on their data that they have. Because if you have a good data, you can know your risk to reward, you can know your win rate, and you can know the amount of losses that you can stomach and that you can handle. So this is a 1 to 20 risk to reward, as you can see right here. This was the full breakdown of the trade. If you want me to keep on uploading this type of video and you have any improvement in my explanation, you can drop it in the comment section and tell me where should I improve my why should I improve my explanation when it comes to this type of setups and when it comes to this type of trading? Because this type of trading is very rare, and this is the synthetic indices. Actually, it's not like the actual forex market. This is indices, and the indices actually is provided by the deriv. If you all know, it's provided by the deriv broker. So if you want to sign up and start trading the volatility index, I'll drop the link so you can sign up to the broker in my bio, and you can be catching this IRR, because this IRR doesn't come always on the forex market. Actually, it usually comes from the indices market, because it doesn't have news on it. It doesn't have news. We don't have those spikes on Monday or the FOMC or the CPI. This is actually pure price action. If you are good with your price action, you can be good right here, and you can be catching high IRR trade, and you're flipping your small $100 account to maybe $1,000 account within one trade. Because this one trade, if you risk $100, you're gonna make $2,000 from this trade alone. If you risk $100 here again, you're gonna make a $2,400 from this trade. How much will that be? That will be almost a $4,400 trade for you. And but not all pro firms offer this type of thing, not the deriv. I don't know if any pro firm has a synthetic indices option, but they have the NAS 100, all the other indices option. But in this synthetic indices, you'll be flipping your small $10 account to $1,000 account within like 3 trades, and with the losses that you can still maximum making 1 hour, 2 hour trades, it cannot hurt you that much. So this is the full breakdown. I hope you like the video. If you like it, please like, subscribe and share, and please let me know if you need any more explanation on this deriv. I'll put the broker down below, and I have my Telegram group also down below. If you have any question to ask me, you can go there and ask me. I'll put my Instagram right at the end of the video. You can go and check it right there also. So love, peace, tweaks, signing out, guys.